Yeah, so as I was mentioning, this is motivated by my sort of recent interest in looking at sustainable finance and green finance. And this work is jointly with this very gifted young student from myself, Pune, Sudeep Deb, very smart young man, and Sankashan Basu, who is Shodeep's colleague in IIM Bangalore. The topic, the name itself, let me just elaborate on this. So, we are talking about transitioning to a decarbonized economy. Obviously, it means that currently we need to look at the extent to which our economy is carbonized, and I'll elaborate more on that. And it is sort of imperative that sustainability itself depends on how we make this transition towards a less carbonized economy. And in particular, in this talk, I would like to focus on quantification of this carbon transition risk. And when I use the word risk, I am essentially looking at the traditional idea of risk from the point of view of investors. In fact, it is interesting to note that even for the financial risk management regulations, there is a lot of activity going on right now to bring about regulations for resulting from the risks that are associated with the climatic changes, in addition to the already established regulatory requirements pertaining to your credit market, operational risk, leverage, liquidity, and so on. Since this is sort of not a very familiar topic, uh, so I'll just talk a little about this carbon transition first. As I have already observed, that the increasing carbon footprint and consequent climate changes obviously is going to force consequent legislative and regulatory changes. So obviously, as you are aware, that there is an increasing pressure globally for governments to adopt strict regulatory measures from every perspective in order to ensure that sustainable development goals are reached. And one specific aspect of these regulations would be potentially a mandate coming on firms towards achieving a significant reduction in their carbon footprint. Now, this fundamental paradigm shift, that is, when we are moving from a carbonized economy to a decarbonized economy, this is expected to trigger consequently a risk for investors, in particular investors or in firms which have a high carbon footprint, right? So that is obvious that if legislations are brought in place requiring significant reduction in carbon footprint, that immediately has a direct ramification on the people who are heavily invested in such firms. So the narrative on these climate-related factors and this financial risk that is there. So obviously here we have identified that there is this financial risk that is being faced by the investors of such firms, and so obviously they are going to look at its consequent management. And when I talk about consequent management, I essentially look at the time point at which this transition in terms of legislations will come into picture, and then how do these investors in such firms prepare in terms of attaining their risk mitigation of their investment in these high carbon footprint entities. Now, the entire narrative on this extent to which the investors of such firms or firms in general, uh, they uh, they can assess the risk and accordingly act on it. It begins with a proper disclosure of which could lead to such risks, and this end in the end becomes the primary drivers of this narrative. So actually the focus greatly the focus is on looking at risk measurement and risk mitigation technique, But prior to that, the bigger challenge lies in terms of a transparent disclosure forthcoming from the companies. Now, to this end, a task force on climate related financial disclosure was formed, and it released its report sometime in 2017. And one of the things sort of that were emphasized by TCFD was to encourage various climate related disclosures or protocols such as the CDP, CDSB, and sustainability, the SASB. In addition to that, of course, there are various boards where through which you can disclose, companies can disclose their extent of carbon footprint. Now, even though the report of TCFD is there, and it lays down guidelines as to how one can achieve greater and greater transparent disclosure. In practice, this is mandated only in a very few countries, and the only prominent one of them is UK. And the consequence of this is that even though the guidelines are there in place, in absence of regulations or even minimal regulations, obviously the companies will not be forthcoming, and there is a consequent insufficient reporting. So, so in terms of investors actually having access to this information, since there is no regulatory requirement to disclose this information, a lot of this information has to, in practice, has to be collated either through manual exercise or through the use of AI. So, in fact, the former, namely the manual exercise, is what Soudeep did with great diligence, and I'll come to that in a few minutes. And exactly that is the precise reason why that there is an increasing clamor for for voluntary reporting to be replaced with more formal regulatory framework akin to, say, for example, Basel regulation or solvency. A brief literature review. As I have already indicated, TCFD has noted that a pattern of selective reporting. So that is, of course, in absence of any mandatory requirements, you are going to see selective reporting by firms. And now, when I talk about this reporting, so there are So by this I mean companies reporting the extent to which they are making emissions. And for emissions, we can look at emissions into scope 1, scope 2, and scope 3, which I'll come to shortly. But the voluntary disclosure of scope 1 emissions, so scope 1, as the name itself suggests, is the direct emissions that are actually made by this particular firm. And it was observed historically, at least a decade or so back, that voluntary disclosures were, in fact, there was not enough incentive for firms to make a voluntary disclosure, particularly because especially in terms of firms which were more energy efficient, that they were offering lower returns of investments, and they were facing enhanced disinvestment by the institutional investors. So accordingly, what you need to look at and what we are going to discuss here is that what is the overall transition risk, and we are going to look at some specific risk component akin to what you look at the single index modeling that you must be familiar with, basic portfolio theory. Now, obviously, we need to keep in mind that when there is a high carbon footprint, obviously the investors expect and do attain higher returns because there's a greater likelihood that any future regulations will impact their returns negatively. So obviously the investors expect and do get higher returns. This is sort of empirically established, and we'll reiterate that in this lecture. So now, there are there's a lot of views on this short-term and long-term impact and also in the context of economies that are more dependent on traditional fossil fuel and the ones that are more moving towards a more energy-friendly paradigm. Now, the question that we want to look at is that does carbon emission constitute a systematic risk factor? So always, if you look at the risk the risk setup, obviously there is a systemic risk factor and there is an unsystematic risk factor. So the former is non-diversifiable, what the latter is diversifiable. So here we are more worried about something that is at a global level, the risk factor that is more global in nature and which cannot be diversified away. So as I've already mentioned, the investors of such firms with higher carbon footprints are increasingly demanding higher returns for their exposure. Now, even in the banking sector, this is something that has been taken note of. And 2015, if you look at the literature, 2015 was really the point in time when banks initiated a premium, initiated the pricing of this exposure. So that means they were charging higher interest rates for credit for firms which are involved in more polluting activities. So that was really the first idea of this concept of green banking, where lower interest rates was offered to firms which are more compliant with and more committed to clean energy. And the reason is that they recognize that any investment in fossil fuel industry, if you have a fossil fuel industry, and if the bank is funding any investment in fossil fuel industry, obviously that infrastructure cannot be dismantled very quickly and is likely to be there for the next 3 or 4 decades. So keeping all these things in mind, what we are going to do is we are going to look at in this lecture at 2 things. One, we are going to look at a data analysis for S&P 500 companies, and we are going to do modeling of that through a linear model. And then we are going to look at a slightly more mathematical setup, trying to capture the time point, the contingent of the time point, what is going to be basically the risk premium. So for that, the second part, of course, things will be more consistent with the traditional pricing theory setup, along with a bit of help from credit risk management. So here, as I mentioned, the data that we considered was for S&P 500 companies. As I had mentioned, this data was collated based on publicly available disclosures of firms which are made to external organizations, or firms will have their sustainability reports. So manually, each of them had to be checked for capturing the extent to which the firm has been indulging in emissions. So this was one. So there was one set of data or one type of data which related to carbon emission, which had to be done in a sort of on a case-by-case basis. And then we had a more structured data that was available pertaining to company financials and stock prices data, and these were taken from Yahoo Finance. Now, when you looked, of course, the data from Yahoo Finance was already, everything was nicely set up, but so that's why I want to emphasize more on the data on carbon emissions. So out of these 500 companies, the emissions data were found for 208 companies for this 5-year period of 2015 to 2020. And finally, after looking at those data, we were able to see that 197 firms, they had the data which was usable. And the data that we considered was mostly scope 1, was essentially scope 1 and scope 2, according to the greenhouse gas protocol. Using scope 3 would have significantly diminished the extent to which the number of firms for whom the data was actually usable. So scope 1 is direct emissions, scope 2 is indirect emission. By this, I basically mean an example of scope 1 data would be the direct emission. Scope 2 would be an example of a scope 2 emission would be this huge IT companies who have these data centers which are generating a lot of heat, or the extent to which they're using electricity and so on. So scope 1 would be just the direct emission that you see, and scope 2 is basically indirect emission as a result of that particular firm using sources where there is the sources of pollution or polluting sources are used essentially to generate energy for usage of those firms. And scope 3, of course, is kind of a tertiary data. For example, some companies might be keeping track of the number of miles clocked by their employees while traveling by air. So that is one example of a scope 3 data. Now, coming to the Yahoo Finance data, what we did is that we looked at income statements. So the two kinds of data that was picked up from Yahoo Finance was total revenue and total expenses. And under the balance sheet, we look at the total capitalization, invested capital, total debt, and tangible book value. So these were just account book data that we picked up. So starting off with these two sets of data, we now just pose this question of carbon risk transition premium. What is this carbon transition premium? So as I've said that, it is essentially the higher returns that uh, will act as an incentive for the investors of such highly polluting firms to stay invested. Okay? And so this is what is known as the carbon transition premium, that okay, we as an investor of such firms, I'm expecting an additional amount of return which should be enough to compensate for my capital loss, when the stock price falls, as in when the regulations come in. So accordingly, what I first define is, I define what is a carbon risk premium. Say for a firm I, the carbon risk premium for a year T is defined as the difference between the annual stock returns and the risk-free stock returns in the year T. So by this, what I mean is basically risk-free here does not mean risk-free the traditional sense that this is some risk-free investment like a fixed deposit or a money market account or something like that. But here it basically means that it is going to be the difference between the return of an asset where if the company is polluting, comparing to the returns that you would get if the company is not polluting. Now, how are you going to quantify this further, and how are you going to capture this in terms of a model? So accordingly, we have proposed this model to a great extent motivated by some of the existing literature, and we perform a cross-sectional analysis for this linear regression model. So if you observe carefully, what we have done here is that we look at the return of a particular asset. All right. So this row, by the way, is the log return. So and R here is the actual return. So I take this linear regression model. Now this linear regression model has two generic components. So this is like so here my alpha naught is something similar to alpha that you see, and here we have two terms, one which basically two terms motivated by the two kinds of data that we have considered. So one of them is going to be this alpha 2 into this h dimensional vector, where these components of this vector, these are going to be the various the data that we picked up from Yahoo Finance, mostly accounting data. And this is the component that will pertain to the total carbon emissions, scope 1 and scope 2. So basically the return here has the component, one of which captures the emissions data, and the other is the regular parameters of the financials of the company. In addition to that, of course, we have as usual, we have the idiosyncratic error or the diversifiable risk. Now here what we are going to do is the crucial thing is to estimate my alpha naught, this alpha 1 and this vector alpha 2. And amongst them, alpha 1 is a crucial vector because this is the vector alpha is a crucial parameter, because this is the one that is directly indicative of the extent to which the carbon emission as given by this epsilon, this carbon emission, this carbon emission, the impact of the carbon emission on the return, which in turn, this term will indicate essentially the additional return that comes to as a result of investing in a particular firm, which can be attributed to the extent to which the firm is actually polluting. So if your E here, basically the company has no emission, so naturally this is going to be zero, and you are back to your usual multi-factor model that one is familiar with. So now taking this equation for the return, what you do is that we exponentiate both sides. So that is why I said this was the log return. So rho it is basically e raised to it. So accordingly, this rho it is going to be this component, e raised to this component. Now, what I want to observe here that the term where I had rho it 0, what is that going to be? That is going to be the return that you would get in absence of any emission. So that means that it is the return that is independent of any emission, or the return that you would get in absence of any emission by the company, that is going to be, will comprise of all this term except this alpha 1 term. So rho it and rho it 0, these are going to be related by this particular relation. So now the question what I want to answer here is that rho it is basically the return that you are getting in absence of any pollution, and rho it is basically is a return that you are getting as a result of pollution. So that means what is going to be the risk premium? The risk premium, which is the difference between these two, you would recall that rho it minus rho it 0. So this turns out to be rho it 0 into this exponential term minus 1. So that means this equation 2 reiterates the importance of alpha 1, and depending on alpha 1, you can see whether this PIT is going to be positive or it is going to be negative. So with this in mind, with the model being driven by the formulation of the model being driven by the data available, we can now do our cross-sectional analysis of those 197 companies. And we have estimated the data. We have estimated our alpha naught, alpha 1, and alpha 2, which you remember that was a vector of 8 components. So these are the coefficients, that is the values of alphas, the standard error, and of course the confidence interval. And interestingly, we find that the value of alpha for all these companies turns out to be 0.00151. So this means that obviously this term is going to be greater than 1, and naturally, so that means this PIT is going to be positive. So that means you are going to get a higher return, which can be a higher return because you are invested in a firm which is polluting in comparison to what you would have got had the firm been not polluting. So this means that a greater carbon footprint will give a higher returns to investors. So once your alpha 1 is fixed, of course, higher the value of your amount of carbon footprint, obviously higher is going to be the value of your P. So this is suggestive. Of course, we are not making an emphatic statement. This is suggestive of the existence of a significant positive carbon premium in stock prices of the firms that we are considering in our data set. Now, this is a histogram of the risk premium. There is slightly some problem with the y-axis. So basically, what it does is that it basically is a histogram of the carbon transition risk premium. That is the extent of which you are going to get an additional return because you are invested in a firm which is polluting as compared to when you would not be polluting. Then this carbon transition risk premium, you see that that there is a lot of concentration somewhere between 1 to 3%. So this is sort of based on the empirical data, roughly 1 to 3% of the price at purchase. That is the extent to which you are going to get your premium because you are invested in this polluting firms. And here you have this variation of the carbon risk premium with the log of emission. So basically, this is looking at the premium that you are getting vis-a-vis the extent of the log of the annual greenhouse emissions, scope 1 and scope 2. Okay, now that we have sort of seen empirically that we have this extra money or the premium that you are getting, what I want to look at is I want to look at this in a more quantitative manner. And I want to introduce something which is known as a single event transition risk. Now, you see, there are not too many regulations in place, so which means that we don't have enough data to really comment on the exact nature of the arrival of the carbon transition risk. And consequently, the exact magnitude of the risk you cannot be modeled. So what we do is instead we propose sort of a risk measure, which you call as the SATR, or the single event transition risk. That will give us an idea of the maximum exposure of risk to a single transition event. So we're looking at a very simple setup where you assume that there is going to be like one legislation which will come and hit, and what is going to be the consequent maximum exposure once we are hit with that single transition event. So naturally, when you're talking about a single transition event, so this is something similar that you get in credit risk, that you are going to have either a default happens or it does not happen. So you can view this analogously. So accordingly, we model the arrival of the transition event as a process which you call as R of t, which is 1 if the event happens, if the transition happens at t, else 0. So, and here please remember, the transition event that I'm referring to here is the time point at which the legislation is going to kick in. So now let probability of TATB, this denote the probability of the transition event happening in a time window of TATB, that is, there existed T such that R of T is 1. Now for an initial time point T naught, suppose that we are considering an initial time point T naught, and it is a time point prior to any low carbon transition or regulation yet to happen. And then from that time T point, we get for that time T naught. So beyond that, what you can do is that we can model the arrival process by some probability density function tau of t. So if I use that as tau of t, so naturally this probability of this legislation happening in a future time horizon of TA to TB, it is going to be integral of tau of t. And obviously from T naught to infinity, this is going to be equal to 1. Now let us talk about specifically about this from the point of view of an investor who buys a stock at this particular time point T naught. Remember, this time point T naught happens before any legislation comes in, and of course I mean here the stock is going to be in a polluting firm. Let us just assume that this pre-risk price to be equal to 1. Now, what you can do is that we can define a real valued function pi, which will describe the potential fall in the price of each share of firm I on a day t when a transition event happens. So we are looking at a future time little t when a legislation comes, right? Or rather, I should say that it is a point where the company is impacted as a result of that legislation, and then on that particular day, the consequent to that event, the price of the stock that is going to fall. So accordingly, so if I have my the price to be so if this fall is captured through a real valued function pi of t, which naturally is defined on t naught to infinity, then we can model the price of the stock as Si star t minus Si minus pi of t into Ri. So remember here Ri will be equal to 0. So basically there is no change in the price as long as that event does not happen. And the moment the event happens, then the Pi will reflect the difference between Si star and Si, which is the price just before the event and the price after the event. So that means this is like Pi is like a capital loss as a result of the fall, a capital loss resulting from this particular transition event. And suppose I identify that particular time point beyond T naught at which this transition event happens as T, then naturally this is a relation that is going to hold between time T naught and T. Because we are not really interested what happens between TE because that event has happened. Remember, we are just talking about a single event. Of course, where one can attempt to look at extending it to multiple time points. So that is again similar to looking at multiple defaults in a credit risk situation. Now, given a probability density tau, so here obviously TE is unknown, we don't know when it is arriving. Now TE is obviously going to be contingent on what is the on its corresponding probability density for this arrival process R. So accordingly, what we are going to find is that we need to find a relationship between the risk premium P. Remember, risk premium P is essentially the additional amount of money that you make, and the ACTR, which is going to be the fall in the stock price. So essentially, you have to do and analyze the trade-off between the fall in the stock price that is likely to happen and make an assessment vis-a-vis what is going to be the extent of this premium you are getting, and whether the premium that you are getting in terms of additional returns, whether the accumulated premium till that event happens, whether it is more than the fall in the stock price or whether it is less. So what is going to be the relation? So accordingly, what you are going to do? Now, what does the investor expect? Now, obviously, the investor expects that the constant flow of the premium that starts at time t0 and goes all the way to this time te, that has to be, this accumulated premium must at least compensate for the capital loss that they are going to experience as a result of the fall in the stock price. So to this end, what you can do is that the amount of money that the investor will expect to receive as premium from the time of investment t0 to the point where the event happens te, that is going to be given by this relation. So this is going to be over this process, and then your PI, P subscript I, is going to be the process, the premium process. So now if you, as a simple case, of course, things get more complicated if I take this PI of T. So I'll say that, okay, they're receiving a constant premium flow, which are denoted by PI of T0. So accordingly, the amount of money that is accumulated in terms of the premium till the final, to the point contingent on the arrival time whose process is given by tau. So this AI is going to be given, the specific case of AI with constant premium is given here. And this, of course, can be decomposed into these two terms. Now, obviously, we see the first term is going to be equal to 1. The first integral on the right-hand side is, what is this? This is essentially, the first term is nothing but the expected value of the arrival of the event, or you can view this as some kind of the expected value. It is the expected value of the time at which the legislation is going to kick in. And as the second term is going to be, of course, T0 into 1. So what does this become? This now becomes the amount of premium that is accumulated, that is going to be given by the premium PI of T0 per unit time, that is a continuous flow of premium, into the expected value of the arrival time of that legislation minus the time at which the stock was purchased. So this is sort of very interesting. I mean, this is, of course, when you look at this form, it seems sort of something that is obvious, that this is the difference between these two is going to be the time spent, or the expected value of the time spent from the time of investment till the time at which your legislation will kick in, and you multiply this time with the per unit time of the premium flow, and this is obviously going to give you the total premium flow that you can expect. So this is an interesting thing to point out about, is that it is that the amount an investor can expect to earn from the risk premium. Remember, the investor is earning a total amount of AI by way of risk premium. It does not really depend on the form of the arrival process, but only depends on the expected time of the arrival. So it's only the expected value. And of course, underlying, you will have the process driving it. Now, the question is that if this is the expected value of the premium, how do you determine what is the fair value of this premium, the fair pricing of the premium, right? Now, obviously, again, here I'm going to pick up from the risk neutral pricing concept, that whatever is going to be the accumulated premium till the event happens, that must be equal to the expected loss resulting from the fall in the stock price at time te. Naturally, right? I mean, the company will only, to be fair to both the parties, the company will only pay that much of premium per unit time, so that the accumulated premium is exactly enough to compensate for the fall in the stock price at time te. So accordingly, this accumulated premium, this is going to be the integral or rather the expected value of the fall in the stock price, the process driving the fall in the stock price, where your tau, you recall, is the process that is going to give you the arrival time of that particular event. So again, if you consider a small time window, t naught to t plus delta t, and you do a bit of calculation, it turns out. So I'll skip these calculations. Uh, it turns out that so we arrive at this, uh, and we're actually able to get the value of the ACTR explicitly in terms of the arrival process stop. So remember, I started off by talking about that we need to relate the risk premia with the the ACTR, that is the extent to which the stock price will fall. And it turns out that the extent to which the stock price will fall, this is has an explicit form as given by equation 5. Okay. So now, obviously, in order to have a better clarity on this, we will need to have look at what is the arrival process tau, right? So what you can do here is that you can estimate. So basically, you can estimate, what is this P, and then if you have a process for tau, you can calculate what is the premium that the company should be ready to pay the investors. So in order to look at this, instead of just sticking to the generalized form, I will just come to the last part of this discussion, and we'll look at some special simple arrival process, as since this is the early stage of the work, and we just look at three willfully chosen arrival process: exponential, uniform, and gamma. So this is exponential distribution. So if you actually pick up this value of tau to be exponential, it turns out that the ACTR, that is the amount by which the stock price falls, this is going to be equal to pi of t prime over lambda. So basically here we see that the value of the ACTR is independent of the time when the transition event happens, and only depends on the value of the premium that is being paid continuously. Now, so these are just some variation of the ACTR, that is the extent to which the stock price is going to fall, and the fall is being viewed in terms of the percentage of the stock price. So this is the variation with 1 over lambda and variation with lambda. Coming to the uniform arrival process, I'll explain a little later as to why these three were chosen. Coming to the uniform arrival process, it turns out that the ACTR is going to be pi of t prime theta max minus t prime. So here it actually is dependent on the is a linearly decreasing function of the time of arrival. So in the previous case, remember, pi of t prime, I have assumed this to be constant. So in the previous case, there was no dependency on the time of arrival. But here, if we choose the arrival process of the legislation to be dependent, to be a uniform process, then it turns out that there is a negatively linear behavior relation or dependency of the ACTR. And again, this is the variation of ACTR with theta max for various values of time t prime. And finally, I want to look at the gamma process. Now, in the gamma process, this turns out to be a little more difficult to compute, but it turns out that this here, naturally, this is going to be dependent on t prime, and it is also there is sort of there is no clear kind of a relation that you can conclude as to how it is going to behave vis-a-vis t prime. And so here you can see the variation of the ACTR as again, if you take your pi of t to be 1%, so you can look at how the variation happens for a gamma arrival process for different parametric values. So you can see that the ACTR is behaving in this case for certain set of values it is increasing, and certain other set of values it is decreasing for different set of values. So here this itself is an indication of how why we chose the three different processes, and how the behavior of the variation of the ACTR can change depending on what model captures the arrival process best. I'll come back and visit this, and I'll talk about these three specific forms. But I want to answer first pose this critical question: that are the premia worth the risk? That means that if you want to get into an investment in such firms, so obviously you are going to expect a premium, and then is this premium is it a sufficient compensation for the risk that you are taking? And the way to look at it is the following. So remember that your PI of this your PI of TE minus T naught. So basically, I'm not removing the expectation here. This is going to be a random variable representative of the accumulated premium that you are going to get. And this accumulated premium, if it has to be worth taking the risk, it must be more than the drop in the asset price, that is your capital loss, that you will experience when that event happens. And this is worth taking the risk only if this entity on the left hand side, that is the accumulated wealth, exceeds the capital loss that you are going to incur when that event happens. So therefore, so accordingly, what you need to do, and accordingly, we have to decide, in order to find our likelihood of making profit and loss, we need to find the area under the graph of the probability density function here, for which this condition will hold good. So if the area is greater than half, then the investor stands a better chance of making profit. So here actually you have to make a call as to whether this condition is, you have to verify whether this condition is satisfies or not. And this is where I come to the specific choices of the three distributions. So the right hand side of this, that is the SATR. This I have already computed for the three processes. So if we assume, say, our T naught to be equal to 0 for simplicity, then the condition of whether it is worth taking the risk or not, assuming that the arrival process is an exponential process, will require that we should have the arrival time should be greater than 1 over lambda. All right, and remember that we are here, the exponential distribution is the driver which captures the arrival of the legislation. So if you work around a little bit, it turns out that this probability, so it turns out that on making an integration, you see that the likelihood of this happening is less than 0.5. So that means if the arrival process is exponential, then it is not worth taking the risk. In case of uniform distribution, you see that the likelihood of this happening is more than half, and you decided, okay, it is worth taking the risk. And half is, of course, an illustrative value chosen to be kind of a benchmark whether it is worth taking the risk. And so in this case, it really doesn't matter whether if the arrival process is uniform, it is sort of like a risk neutral kind of a situation where it is in terms of is it worth taking the risk, you don't have any obvious way of choosing one over the other. And finally, for the gamma distribution, actually it is a bit of mix, because this condition reduces to a condition like this, which is slightly implicit in nature. And so if you look at here, if you set your threshold to be equal to half, so you see that for certain values of A and B from the gamma distribution, it is worth taking the risk, but for certain other values, it is not worth taking the risk. So I just want to conclude. I'm kind of running out of time, so I just want to conclude just some key takeaways. And please, I would just want to make I want to put forth the caveat that these talks, the key takeaways I'll mention, of course, is mainly driven by my specific choices of this illustrative choices of the various distribution. So you see, while the stocks of these highly polluting firms, they might look attractive in the short run, they can pose significant risk in the long run, as we have seen in some cases when we decide that, okay, we don't, it may not be always worth taking the risk. Now, this risk will depend on the amount of emissions produced by the firms and the probability distribution of the arrival of the low carbon transition event. So remember that, what is the risk? The underlying risk here is the loss that you are going to face as a result of the fall in stock, which, if you look at the formulation of the ACTR, indicates that, well, it is going to depend on the process of tau of the arrival of the carbon transition, and of course, whatever is your constant amount of premium that you are going to get. Now, despite the pricing of the risk being fair, so basically the pricing of the risk is fair, and the pricing of the risk, by essentially I mean that you have calculated your premium in a fair way. But as we have seen, contingent on the different processes, the probability of making profits or rather not facing loss need not be, even in case, for example, in case of exponential distribution, the odds of making money is always lower than the odds of losing money. So there are situations where, in spite of you making this, correct risk neutral kind of valuation, you have a very high likelihood of losing money. Okay, these are the main observations. So we are right now also working with Sudeep and Shankashan Basu. We are working on looking at portfolio optimization, where the approach essentially is to look at two portfolios. One portfolio is what we'll call as a green portfolio, and the other is a benchmark portfolio. And the idea is to essentially create a green portfolio out of this benchmark portfolio, or out of the constituents of the benchmark portfolio, so that you are able to reasonably mimic the return of the benchmark portfolio, as long as this legislation does not come in. And once the legislation kicks in, then obviously that green portfolio is going to significantly outperform that of the baseline portfolio, or the reference portfolio. So that is another direction where this can go, and that is that is another key component that one can look at in terms of looking at the future direction. And the preprint of this work is available on arXiv, and as I mentioned that this work is still under review. And with this, I conclude this presentation. And if thank you all for listening patiently. And at this point, I would be happy to answer if your questions.
Thank you very much for this very nice presentation. And yeah, so if there are any questions, participants can ask. Before that, I would also like to express my gratitude for the participants to be here with us during the Friday night. Yeah, so please, if there are any questions, please go ahead and ask.
Hi, I have a question. First of all, really nice talk. It's very interesting to connect climate change, this carbon risk, to this kind of economic things. Just going back to the model that you used to identify this carbon risk thing. So you used a linear regression model, right? So I have two-part question to that. One is linear regression simplistic model in this framework? And the second question is that alpha on parameter that turns out to be non-significant. If I saw it correctly, the confidence interval was on both sides of the zero value, right? So do you think that it's going to be appropriate to talk about or base this entire thing on the nature of alpha on, given that the model is identifying it as a non-significant thing, and also the model perhaps can be improved to a more suitable framework for a return series?
Yes. So this is a very good question, right? See, this model we picked up sort of as a starting point, where we looked at some existing identifiers of what are the factors, this multi-factor that can come in. So here I agree with you that this might be a slightly simplistic model, and we can certainly look at a better multi-factor model that is going to capture. And also the other difficulty that we had is, you see, we had only we primarily got scope 2 emissions, and the problem is that the data that we got it was multiple sources. So I don't know whether to some extent that data was impacting the value of alpha. So we sort of, it's like a kind of, I admit that this is kind of not a very strong and convincing argument. And the only thing I want to present in my defense is that, well, PIT is positive, and here it is suggestive of existence of the risk premium based on the data. But I agree, that this perhaps this modeling will need to be improved upon. So as far as I know, really, no, I was not able to locate any work which could give us any clarity, because for this kind of capturing the returns, to capture return which encompasses the the extent of emission that is happening, we could not find anything. So I understand, I clearly agree that this needs improvement upon it. Did you have a follow-up question? Sorry, I just lost my
No, no.
trail of
So yeah, I was asking also about the effect of alpha one, because if alpha one is actually zero, then risk premium is this
No, no,
becomes.
so that is, if alpha 1 is equal to 0, then basically effectively it means that the firm is non-polluting.
Yeah.
Or if your epsilon is 0, then obviously, or then E that is 0, then obviously it's anyway non-polluting because it has zero emission.
Correct. So in your model, you are not finding alpha one to be significantly
Yes,
different.
it is a small number. I agree. But I was just happy to just at least sort of see that, okay, it's a positive number.
No, yeah, that's what I mean. I was hoping or thinking whether there is an opportunity to extend this thing and take
Sure.
more on a substantial statistical improvement on this part, because the later part I
Yes.
found it very solid in its argument. So maybe there is opportunity to extend this further as
Yes,
well.
yes, certainly. A point taken. I will keep in mind, and perhaps we can connect later on to discuss this. Yes. So you see, I mean, when we are working on this, there is so very few literature on climate finance, and most of this literature essentially focuses more on the portfolio side. As I said, looking at a green portfolio and ensuring that the tracking error vis-a-vis a benchmark portfolio is as small as possible. So it's like throwing out the highly polluting firms, the assets out of your portfolio, and then looking at a subset where you trying to figure out what is the best way to optimize this so that you can mimic the benchmark portfolio as best as you can. So most of the literature is almost invariably, the mathematical part of it is almost invariably portfolio related. See, somebody has asked me a question. I would like to know how decision trees can be used in climate premium value. I am sorry, I really don't know much about decision tree. If you can provide me a little more detail. I mean, I don't know. The answer to your questions, I really don't know. I'm not very familiar with decision trees.
Okay. So may I stop recording?
Yes, sure.
Yes. Okay. Okay. So I also have one small